Hi, welcome to the Market Alert for Thursday, the 20th of February 2020. Stocks up, bonds up, gold up, dollar up, oil up, a virus death count up. Stupid as stupid does, which is referring to the continuing bull market and also the BS that came out of the Federal Reserve yesterday when the FOMC meeting minutes with Powell talking about reducing the repo funding in April, which will be very interesting to see if he manages to do that. Here you go, is the headline. FOMC minutes see rates appropriate, warn of elevated asset levels and suggest not QE tapering imminent. It's staggering, absolutely staggering. Good article actually, well worth a read. The reason the repo market came into force, or the funding of the repo market in September the 11th, was simply because short-term rates started to accelerate very, very sharply. So bring it on, Powell. Let's see what happens if you do stop the funding of the repo market in April. So meanwhile, in the daily chart yesterday, a very, very quiet morning and the afternoon, and eventually prices kicking off to the upside. Overnight prices have more volatility than they did the day before. Prices up and then down. But first, yesterday, the pre-market session was just very, very quiet, which is most unusual. I think the market waiting for the FOMC minutes there. But once again, you see the selling followed by the buying, the market then retracing, but then coming back above the 200 MA. And then, as usual, we're off back to the upside. The FOMC meeting minutes were a bit of a non-event for the market. So you see the market being tested there. And then we get the last rally back to the R1 before prices move lower. And then overnight, the market responds with moving higher. And it isn't long before we're below the 20-bar moving average with selling at the previous day's high. And then we've sailed down 150 points. And the market currently on a bit of a bounce up to where we'd expect it, the DP and the 200 MA there. News for today, retail sales, ECB monetary policy accounts, and that's it. And that's all going to be done and dusted by 12:30 or 1 o'clock as far as the accounts are concerned. Meanwhile, in the implied volatility, which I completely forgot about yesterday, we can see that this hasn't altered a lot. It's stuck in a sideways range, but below the 20-bar moving average, as prices remain above the 20-bar MA as well. And you can see this clearly in the color-coded version of the implied volatility. Certainly, it's going to be interesting as Powell talks about non-QE or getting rid of non-QE4, which is, again, BS. This is going to have an impact as well. And the yield curve also has inverted once more. So they have trapped themselves or painted themselves into a corner for sure. So it'll be interesting to see how things start to unfold. But certainly, unless he changes his stance with the market, it's going to struggle to move to the upside unless he announces QE4 or reduces interest rates. But at the moment, he's taking the stance that everything is fine. Meanwhile, Bitcoin daily chart, the market down yesterday, but this didn't happen during the main session, as you can see from the 15-minute chart. Again, it was a very boring, tedious day, $50 moves, if at all. And then as the market session finished last night at 8:30, shortly after, the market then moved to the downside very, very sharply, and then went back to trading in a range. So this continues, as can be seen by the spikes in the 4-hour chart there. Okay, that will do it for this one. Like I say, keep an eye on the Dow. It should pick up a bit today now the FOMC is out of the way. And the knight in shining armor, Powell, didn't really give anything for the market. So it's going to be interesting to see how it manages to continue to move to the upside without the POMO having an active part in pushing prices to the upside. But at the moment, bouncing off the lows, 50% retracement there in prices in the pre-market session, and a nice bit of volatility as well. Okay, that's it as ever. Thanks for watching. See you in the next one.